Welcome to Illuminati Silver. We tell you the truth about silver. Today is Thursday, the 30th of July, 2020. And today we're going to bust the myth that we see peddled on YouTube and social media that banks are on the verge of collapse. But first, we wish to draw your attention to two videos. One produced yesterday entitled Gold Flirts with $2,000 and Silver with $25 as Fed Leaves Rates Unchanged. And on Monday, gold reaches all-time high, silver tops $24. And we've placed links to both of these in the description box below. Now for interest, when we completed yesterday's video, gold stood at $1,979. It has since fallen back to $1,946, some $33. Not huge, but a slight pullback. And silver stood at $24.89, and that too has fallen back to its current level of $23.21. That's a larger percentage fall, $1.68. Now we shall comment more on these moves either tomorrow or during our weekend update published on Saturday. What is worth commenting on, though, is that GDP figures for quarter two were announced or declared today at down 32.9%, which compares with expectations of down 34.6%. Still appalling figures, but a little better than anticipated, though equity markets themselves generally, broadly, are down around 1%. But in the meantime, and the purpose of today's video, is that we wish to put at rest the fear that pumpers, doom and gloom merchants, and a host of other commentators on YouTube keep spreading that we're about to witness major bank defaults, just to scare us all that little more, as if we weren't all scared enough already. So let me just read an article to you. It's about 5-6 minutes long, published in Bloomberg Business Week, which we receive on a regular basis, and generally some of the articles in there are pretty well written by quite authoritative authors. This is what this week's had to say. Bloomberg Business Week article dated July 27th, entitled Awkward. Banks profited from volatile stock and bond trading as the pandemic roiled the markets. By Sridhar Natarajan and Michelle Davis. Quote, a bunch of Wall Street executives got together for dinner a decade ago while the United States economy was in tatters. Their industry, fresh off a bailout, was printing big profits again, and Americans were seething. Congress wanted hearings. As the executives picked at their food, one from Goldman Sachs Group Inc. turned to his peer from Morgan Stanley, which had been slower to bounce back from the crisis, and said, "You have no idea how damned lucky you are to lose money with a hopeless business model." The table erupted in laughter. The kernel of truth in the quip is that nobody likes bankers profiting as the world burns. It draws a harsh spotlight. Over the past week, Wall Street's 5 biggest investment banks disclosed $45 billion in revenue from trading and deal-making units, marking those businesses' best quarter in modern history. The catalyst? A deadly global pandemic and the Federal Reserve's unprecedented measures to prop up the economy. It's hard to imagine a more awkward time to land a windfall. For years, bank trading chiefs have been begging, even praying, for a surge in volatility to lift their fortunes by spurring client transactions. Banks finally got their score as markets plunged, with television screens showing refrigerated morgue trucks. Then they made even more money as authorities rushed to help. Morgan Stanley posted its highest revenue and profit ever. JP Morgan Chase & Co. blew past the revenue record its traders notched in the first quarter, topping it by 34% in the second quarter. Goldman's profits rose, even as the company set aside an additional $1 billion to cover potential legal costs, including those relating to probes into its role in the looting of a Malaysian investment fund. The numbers were high enough that the ranks of sell-side stock analysts, sometimes mocked as cheerleaders for prefacing conference call questions with, "Great quarter, guys," wondered about the potential for a public backlash. Fair or not, banks are being depicted as being on the wrong side of economic inequality and other issues. UBS Group analyst Saul Martinez said on the JP Morgan's earnings call, "I'm just curious if you're concerned at all about populist anti-bank policies gaining traction." Well, at least the banks didn't cause the crisis, unlike in 2008. In recent years, banks maintained their extensive trading operations even as low volatility in the markets made it harder for them to generate profits. One argument for keeping the units was that they can provide a hedge in crises, making money while other parts of the bank suffer from loan defaults and further damage from a slumping economy. In fact, three of the Wall Street giants, JP Morgan, Bank of America Corp, and Citigroup Inc., set aside much of the money generated by the trading bonanza so they can better weather anticipated losses on lending to desperate companies and consumers. Altogether, the five banks stockpiled more than $25 billion in the quarter. Banks are also quick to note that the Federal Reserve didn't step in to save them as it did in the last crisis. Instead, the banks helped head off another meltdown by aiding companies in raising money and avoiding bankruptcy. The most important thing we could do is be a healthy and vibrant bank through this crisis, JP Morgan Chief Executive Officer Jamie Dimon said in response to the analyst. The Fed may not have explicitly paid the banks billions of dollars, but it created an environment in which their success was all but guaranteed. The central bank helped cash-strapped companies raise money to shore up their finances and pay their bills. Banks made money from facilitating the fundraising as well as from the related spike in stock and bond trading. Bank executives say that such is the life of an essential middleman. You ride the waves as they come. But this turmoil happened to keep the music playing at banks after 2019, their most profitable year in history. It's always good to be a Wall Street bank, said Greg Gelsinis, a policy analyst at the Center for American Progress, whether we're in a recession or not. Beyond the worries over optics and deeper policy questions, how effective is the Fed's stimulus in providing credit to critical industries? And how much lining of Wall Street's pockets is acceptable as a side effect? When authorities intervene, can society win more than traders? What of the moral hazard in throwing a lifeline to companies that took on too much debt? Fed Chair Jay Powell has indicated that in this moment those concerns are secondary to saving the economy and millions of jobs. But Wall Street's gains will only revive perceptions that the deck is stacked in its favor. Representative Katie Porter, a Democrat from California, who's been jousting with JP Morgan's Dimon for 15 months, couldn't resist taking a shot after the bank posted results. Why, she asked, should Americans accept bankers becoming richer and richer in the middle of a pandemic? Those sentiments can have big ramifications. The profits investment banks made in the wake of bailouts in 2008 spurred the anti-government Tea Party movement, the Occupy Wall Street demonstrations, and a wave of new regulation. Complaints that the game is rigged later played into the ascent of populism in the 2016 presidential election, and they reverberate today. Banking leaders are well aware of the stakes. Some recently made it clear to their troops that they cannot be seen crowing. If it weren't for the pandemic, Goldman CEO David Solomon might have enjoyed the sight of a packed auditorium at the firm reacting to the best quarter under his leadership. Dimon would have strolled the aisles of JP Morgan's Madison Avenue trading floors, personally saluting his workers. Instead, Solomon met with a couple of dozen executives scattered in the hall in front of him. At JP Morgan, Dimon emailed employees a tightly worded "Congratulations." End of article. Okay, so it's true that in many banking areas profits are down. However, it's also true that in other areas they are up, and up considerably. Now, whether you like banks or not, and we suspect most listening here do not necessarily believe that so many of them are on the cusp of imminent collapse. It simply is not true. Even though admittedly there are some larger financial institutions that are under stress and from time to time have liquidity problems, but many of those are in Europe. And of course, one has to also ask the question, will central banks across the world, and certainly in some of the larger economies, even allow their major banks to collapse in the first place? Anyway, did this article surprise you? Do share your thoughts. And thank you so much for listening, and if you haven't already done so, please subscribe to our channel and press the bell sign so that you're notified of our videos as and when they are published. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.